So this is day one of The Core Investor, where I teach finance while planking. Let's start. So your portfolio is probably a sea of red. The Sensex just broke down by over 1000 points. The news channels are in a full-blown panic. And the bizarre part, it happens after the US Federal Reserve did exactly what we expected and cut interest rates. It makes no sense unless you were listening to what Jerome Powell said after the cut. There is an invisible architecture that connects Washington to Dalal Street, and it just triggered a massive capital flight. The real problem is that most people are watching the wrong thing. The rate cut was a distraction. The real story is what's called a hawkish pause. This pause is a coded message to global investors, and it has FIIs, that is, foreign institutional investors, running for the exit. This isn't a correction, it's a liquidity-driven exodus. First, let's decode what actually happened. The market expected a dovish cut. That means the Fed cuts rates and, more importantly, signals that more cuts are coming. But that is not what we got. We got a hawkish cut. Jerome Powell gave us the rate cut, but his commentary essentially signaled that this might be the last cut of the year. God, this is tough. He's worried inflation is still sticky. This is the financial equivalent of getting a good appraisal, but your boss immediately follows it with, and you should be happy with this because the budget for next year is frozen. The good news is completely destroyed by the warning. The market wasn't pricing in a pause. It was pricing in an easing cycle, and Powell just poured ice-cold water on that. So how does a few words from Powell in Washington cause a 1000-point Sensex drop? It's simple. This plank is not. Capital is a coward. It goes where it's treated best and where it perceives the least risk. For the last year, FIIs have been pouring money into emerging markets like India because our growth was high and US interest rates were expected to fall, making US investments less attractive. The hawkish pause just reversed that equation overnight. If US rates stop falling, or worse, could even go up again, why would a big fund in New York keep its money in the riskier Indian market? It's a no-brainer. They sell Indian stocks, convert the rupees back to dollars, and buy safe US Treasury bonds. And that is exactly what's happening. In the last 2 trading days of the week, FIIs have been net sellers, dumping over 9,000 crores of Indian equity. And who is buying? DIIs, domestic institutional investors. Our own mutual funds and insurance companies are buying what the FIIs are panic selling. This isn't a crisis of fundamentals, it's a crisis of liquidity. The FII selling is what is breaking the market. We are now testing a critical Nifty support level of 25,600. If we break this, we could see another sharp fall. So what do we do? Let me be very clear. If your financial goals haven't changed in the last 48 hours, your investment plan should not change either. And that is the most crucial part. Okay, today I'm stopping the plank at around 4 minutes. My goal is to reach 10 minutes by the end of this challenge. Let's see. Let's continue with the video. So, are you investing for the next week or for the next 10 years? That is the question you need to ask yourself. I'll be honest, I've made this mistake before. Years ago, I saw a similar FII-driven crash and I paused my investments. I tried to time the market. I ended up missing the entire recovery and a lot of upside. I learned that you must differentiate between a liquidity event and a fundamental event. Is the Indian economy broken? No. Are the companies in your mutual fund suddenly bankrupt? No. This is hot money leaving the country. The dumb money is panic selling. The smart money, the DIIs, are buying the discount. For a long-term investor, this 1,000-point drop is not a crisis, it's a sale. You are now buying more units of your mutual fund for the exact same amount of money. This is literally what dollar cost averaging or rupee cost averaging is designed for. So, let's recap. The Fed cuts rates, but Jerome Powell's hawkish pause spooked global markets. It signaled the easy money train is stopping. This triggered a massive FII sell-off, which is why the Sensex is down 1,000 points. This is a liquidity-driven crash, not a fundamental one. Domestic institutions are buying what foreign institutions are selling. Your action item is not to check your portfolio every 5 minutes. It's to close the app, take a breath, and review your own financial goals. The first step to building real wealth is to stop reacting to the noise and start acting on your plan. But remember, I'm just a guy planking and talking about money, not your financial advisor. So do your own research and see you tomorrow.